5 investing tricks Charlie Munger used to become a billionaire. Charlie Munger has been managing investments for a long time. The billionaire says that making and keeping money has never been harder for young people. Munger said that it has become much harder to do well in the investment world over the past few decades. He also said that even with inflation, the cost of living in many parts of the US is much higher than it has ever been. Munger has given many tips over the years on how to invest and avoid common mistakes that can cost you money. Ethics are the most important part of his way of doing business. Good businesses are ethical businesses. A business model that relies on trickery is doomed to fail, he said. He also said that you should only invest in businesses you understand and that have a long-term advantage over other businesses. The management of a company must also be honest and talented, and you should be able to get it for a fair price. A great business at a fair price is superior to a fair business at a great price, Munger said. So if you want to make money and not make mistakes that will cost you money, it might be a good idea to listen to some of Munger's advice. Number 1. If the opportunity isn't completely obvious, it's not a great one. The idea behind it is that a truly great opportunity should be easy to recognize and understand. If an opportunity is not obvious, it may indicate that there is something about it that is not entirely clear or that there is significant risk involved. It may be worth taking the time to conduct additional research and due diligence before making a decision. This may involve looking into the industry and market conditions, analyzing the financials of the business or opportunity, and talking to experts and other industry players. Number 2. Managements are important, but averaged out, betting on the quality of a business is better than betting on the quality of management. While management is important, it's not the only factor to consider when investing in a business. Instead, focusing on the overall quality of the business, such as its products or services, its competitive position in the market, and its financial health, is a more reliable way to determine whether it's a good investment. Number 3. Successful investors or successful bettors all have one thing in common: they bet very seldom. This approach is often referred to as being selective or picking your spots. It involves taking the time to thoroughly research potential investments or bets and only putting money into those that have the best chances of success. By being selective, successful investors and bettors are able to limit their losses and maximize their gains. One of the key benefits of being selective is that it allows you to avoid making impulsive decisions based on short-term market fluctuations or other temporary factors. Instead, you can focus on the long-term fundamentals of a particular opportunity, such as the strength of the underlying business or the potential of a particular technology to disrupt an industry. Number 4. Investment success is not in the buying or selling, but in the waiting. This refers to the idea that the key to success in investing is not in the act of buying or selling an investment, but rather in the ability to hold onto it for an extended period of time. This idea is closely related to the investment strategy known as buy and hold, which involves purchasing stocks or other assets and holding onto them for a long time, rather than frequently buying and selling in response to market fluctuations. One of the main reasons why holding on to investments for an extended period of time can be beneficial is that it allows the investor to ride out short-term market fluctuations. Stock prices can be highly volatile in the short term, moving up and down in response to a variety of factors, such as earning announcements, economic news, and even global events. By holding on to investments for a longer period of time, the investor can avoid being swayed by short-term fluctuations and instead focus on the long-term fundamentals of the underlying business. Number 5. All long-term successful companies eventually experience advantages of scale. As companies grow and expand, they can gain certain advantages that can help them to become even more successful in the long term. One advantage of scale that companies can experience is the ability to negotiate better deals with suppliers and partners. As a company becomes larger, it can exert more influence over suppliers and partners and may be able to negotiate better terms for raw materials, transportation, and other goods and services. Additionally, companies that have a larger market share can enjoy brand recognition, which would make it easier for them to market new products and services and increase customer loyalty. One of the main advantages of scale that companies can experience is the ability to lower their costs. As a company grows, it can spread its fixed costs, such as research and development, infrastructure, over a large revenue base, which can lower the cost of each unit of production. This can make the company more competitive by allowing it to lower its prices or increase its margins. In any event, it is essential to keep in mind that every opportunity comes with its own set of one-of-a-kind qualities. The trick is to figure out whether or not the opportunity aligns with the goals and objectives you have set for yourself, as well as what kinds of risks and returns you can anticipate from the investment. That's all for today, and we'll be sure to catch you all in the next one.